You're walking down the road and all of a sudden you see a large group of people running in your direction. What do you do?
Don't run! Don't run! Murife! Murife, don't run! Hey! Murife, don't run!
Yeah, that is what most people would do. It is natural for your instincts to tell you to follow the masses, but such an approach when it comes to investing is very dangerous, and today I would like to show you why that is the case and what you can do in order to counter their feelings that lead to such a behavior. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Investing is a crucial aspect of financial planning and wealth accumulation. It involves allocating resources with the expectation of generating returns in the future. While investing appears to be a straightforward activity, it involves various psychological factors that influence an investor's decision-making process. Psychology plays a critical role in investing, and an understanding of it can help investors make better investment decisions. With the markets currently seeing a lot of downturns due to various factors like the rise in interest rates, high inflation, geopolitical issues, and in South Africa, an energy crisis that seems to be getting worse with each passing day, a lot of people don't have a very positive outlook on investing. I've had a lot of people around me complain that they are down a lot of cash and that their portfolios are made up mostly of falling stocks that are in the red. This made me think of the importance of understanding the psychology needed in order to become a successful investor. The first psychological factor is risk tolerance. This is one of the essential psychological factors in investing. It is the degree of risk an investor is willing to take when investing. It is influenced by various factors such as age, income, investment experience, and financial goals. For example, younger investors who have a longer investment horizon and less financial obligations may be more willing to take on risk in their portfolio to potentially earn higher returns, while older investors who are closer to retirement and have more financial responsibilities may prefer a more conservative approach that prioritizes stability and income. A lot of people are often paralyzed by the fear of losing everything because they don't understand how risk works, or they have a low risk tolerance due to the lack of education about the world of investing. As Wayne Gretzky, the famous ice hockey legend, once said, "You miss 100% of the shots you don't take." That being said, not every shot is worth taking, and understanding which ones are will serve you well. It's important for investors to understand their risk tolerance level and use it to guide their investment decisions. This can help them build a portfolio that aligns with their goals and preferences while managing their exposure to potential losses. A financial advisor can also help investors assess their risk tolerance level and develop a suitable investment strategy that balances their risk and reward. This moves us to the next factor: biases. Investing is a complex and challenging process that requires rational thinking and informed decision making. However, investors are susceptible to biases that can lead to irrational decision making, which can negatively affect their investment outcomes. Confirmation bias occurs when an investor seeks information that confirms their pre-existing beliefs rather than objectively considering all available evidence. For example, an investor who believes that a particular stock is going to perform well might only seek out information that confirms their beliefs, such as positive news articles or analyst reports, while ignoring negative news or warning of risks. The bias of overconfidence occurs when an investor overestimates their knowledge and skills, leading them to making investment decisions that are not based on rational analysis. For an example, an investor who has had success in a few investments may become overconfident in their abilities and start investing in high-risk assets without fully understanding the risks. This kind of bias makes you more of a gambler than an investor and can be quite detrimental to your portfolio in the long term. Loss aversion occurs when an investor experiences more pain from losses than pleasure from gains. This bias can lead to irrational decisions such as holding on to losing investments for too long or selling winning investments too early. For example, an investor may hold on to a stock that has significantly declined in value, hoping that it will recover even though the evidence suggests otherwise. This is one of the biggest reasons I see for people losing money in the stock market. It can manifest itself in the next psychological factor too. To avoid the negative effects of these biases on investment decisions, investors should recognize and manage them. This can involve seeking out information that challenges their pre-existing beliefs and avoiding overconfidence by seeking advice from experienced professionals and developing a disciplined investment strategy that accounts for both gains and losses. With that in place, you then have to manage the next factor: emotions. Investing involves making decisions about where to put your money in order to grow it over time, but emotions can interfere with these decisions. For example, when the stock market is going down, people may feel afraid and sell their stocks in a panic. This can cause them to miss out on potential gains when the market eventually rebounds. On the other hand, when the market is doing well, people may feel greedy and take on too much risk by investing in risky companies or assets. This can lead to losses if those investments don't perform as expected. And as mentioned before, people may hold on to losing investments out of hope that they'll eventually turn around rather than cutting their losses and moving on. To avoid making poor investment decisions, it's important to manage those emotions and instead rely on logic and evidence. For example, investors can create a diversified portfolio that balances risk and reward rather than investing all their money in one company or asset. They can also set clear goals and plan for achieving those goals by sticking to the plan even when emotions are high. It's important to understand that the market has its ups and downs but ultimately goes up over time. So your decisions shouldn't be influenced by things happening in the short term if you are investing for the long term. By making decisions based on solid investment strategy rather than reacting to emotions in the moment, investors can ensure that they make the best decisions for their financial future. This leads to choice of investments. Investors' choices in investment vehicles can be influenced by psychological factors. These factors include personal values, beliefs, and emotions that impact how people perceive and respond to investment opportunities. For instance, some investors may prefer to invest in companies that prioritize sustainability or social responsibility, so they may choose to invest in green energy or fair trade companies. This is because they want their investments to align with their values. On the other hand, some investors may prefer to engage in high risk, high reward investments such as day trading or speculative investments which they caught wind of, which offer a chance for quick gains. This preference may be driven by the desire for immediate gratification or the thrill of risk taking. This normally doesn't end well. For example, we saw what happened in 2021 with GameStop. Those who got in at the right time made some money, while those who decided to try their hand unfortunately got in at the wrong time, just before the market went down, and they got burned. Before getting excited and just buying a stock or getting discouraged and selling it, you should have a reason as to why you wish to do so other than the share price going up or down. If you find it difficult to control your emotions when it comes to investing, then you are better off having a financial advisor or putting your money into a financial institution that will manage it for you. But with enough training and education, you can learn how to overcome your emotions and not let them get in the way of your investment success. You also need to be aware of herd behavior. This is when investors copy each other instead of making their own decisions. Remember the scenario I presented to you in the beginning of people running towards you? That's herd behavior. This happens because people tend to follow what others do when they are not sure what to do themselves. This behavior can lead to big problems in the stock market, like when prices get too high, then suddenly crash. It's important for investors to make their own decisions based on good information instead of just following what everyone else is doing. For example, imagine that a new company starts selling shares of its stock to the public. Some investors think that it's a good idea to buy the stock because they believe the company will be successful. But if many other investors start buying the stock too, even if they don't have a good reason to believe in the company's success, the price of the stock might rise rapidly. This is a bubble. It is not sustainable because the stock becomes overpriced. Eventually, the bubble will burst and the stock price will plummet, causing losses for investors who bought it at the top of the bubble. This is what happened with the dot-com bubble crash in the late 1990s and early 2000s. Many investors bought stocks in internet companies because everyone else was buying them, causing prices to soar. But when the bubble burst, many investors lost a lot of money. Some of the things that can cause this behavior include the very investing platforms we use. I've seen on Easy Equities that normally when you buy shares of a certain company, it will show you what people who bought the same stock are also buying. Another factor can be social media groups where people post about what they're investing in. If you ever find any of the companies that you see others invest in to be interesting, do your due diligence by first researching about the company and determining for yourself if it is worth putting your money into. Do not blindly follow anyone's investment decisions, even if that person is me or Warren Buffett. Not that I would tell you what to invest in, the S&P 500 being an exception, of course. Understanding these psychological factors is important for investors because it helps them make better decisions based on their unique preferences and values. By aligning their investment choices with their beliefs and emotions, Investors can increase their satisfaction with their investment portfolios and reduce the likelihood of making hasty or irrational decisions. It's important to note that investing can be slow and boring. It is a long game and is not a get-rich-quick scheme. It is not trading or some form of gambling. It is you putting money into good businesses that you see great potential in so you can make returns in the long run. I hope this video today has helped shed some light on the things that you can improve on in order to become a better investor. Let me know which psychological factor you feel you need to work on the most in the comment section below. If you found value in this video, then please leave a like and share it with a friend so that they can learn the same things you've come to learn. Subscribe to the channel if you haven't done so already and click on the notification bell so you can stay informed on ways that you can improve your financial knowledge. Every time you like, share, comment and subscribe, you help the channel grow so we can reach more people and they can learn all this good stuff. Thanks for watching. Hope to see you in the next video, but until then, stay invested.